Drop everything. I mean it. Whatever you're doing right now, pause it. Close that laptop. Put that phone down. If you're eating, the food can wait. If you're working, tell them you need 5 minutes. This information is too critical to ignore. If you're behind the wheel, find a safe spot and pull over. Even if you're mid-shower, towel off and pay attention. This is that important. What's up, everyone? This is Tuesday, January 13th, 2026, and I'm here to expose something that's going to make your head spin. Just yesterday, Monday, January 12th, we witnessed silver smashing through the $85 per ounce barrier. Over at the Shanghai Futures Exchange, prices hit an incredible 93s. We were celebrating what looked like the final collapse of the arbitrage game. The conversation was all about how the paper trading system was imploding while the physical market was asserting its dominance. We were watching the architecture of a corrupt system crumble in real time. But then something happened while most of you were asleep. While you were lost in social media feeds or watching another forgettable streaming series, the powers that be launched their counterattack. The Chicago Mercantile Exchange, better known as the CME, the institution that governs COMEX futures trading and writes the rules for paper silver contracts, issued an urgent advisory notice about margin requirements. In this notification, they declared that starting immediately, not in a week, not in 30 days, but effective this very moment, Tuesday, January 13th, they're restructuring the entire margin framework for silver futures contracts. And they're doing it with surgical precision, specifically engineered to demolish retail trading positions, eliminate small investors from the game, force liquidations across the board, and shield the massive banks who are hemorrhaging billions on their short positions. This isn't conspiracy theorizing or wild speculation. This is documented reality. I've got the figures, the calculations, and the historical parallels. I'm going to walk you through precisely what they've executed, the motivations behind it, and what this means for your financial future. But first, you need to grasp something fundamental. What I'm about to reveal will sound almost unbelievable. It sounds like the type of market rigging that people joke about but never think actually happens in regulated markets. It sounds like a Hollywood thriller where corrupt institutions manipulate the entire system. But this is happening right now. It happened overnight. It's unfolding this very second as you watch this. And if you don't comprehend what's occurring, if you panic and liquidate because you see red numbers on your screen, you'll miss out on the greatest wealth redistribution event of our generation. So pay close attention, stay focused, and let me reveal exactly how this rigged game operates. Here's what went down. Late Monday evening, January 12th, the CME distributed a margin notice advisory. This notice announced sweeping changes to margin requirements for silver futures positions. If you've never dealt with futures trading, here's the essential concept of margin requirements. When purchasing a futures contract, you don't pay the complete contract value up front. You deposit a percentage as collateral. This percentage is your margin, essentially a security deposit. Consider this example. A single silver futures contract on the COMEX represents 5,000 ounces of silver. At today's $85 per ounce, that contract controls $425,000 worth of silver. But here's the leverage magic. You don't need $425,000 sitting in your account. Under the previous rules, you only needed approximately $32,500 as margin. This is what makes futures trading accessible. You get substantial leverage. With $32,500 controlling a $425,000 position, you're operating with roughly 13 to 1 leverage. Every dollar you deposit controls $13 worth of silver. This leverage is how everyday traders, people who don't have institutional capital, can compete effectively in these markets. We use leverage to compete above our weight class, and the banks absolutely despise this. When retail traders leverage long positions in silver, when we flood into the market demanding actual delivery, it threatens their massive short positions. It threatens their entire paper Ponzi scheme. So what did the CME do? They rewrote the rule book to eliminate our leverage and force us out of our positions. Here's the specific modification they implemented. The old system used a fixed dollar margin amount, $32,500 per contract. It remained constant whether silver traded at $50, $85, or $100. The margin never changed. The new system, effective immediately, calculates margin as a percentage of the contract's notional value, specifically 9%. What does this actually mean? The margin is no longer a fixed number. It now fluctuates as a percentage of total contract value. With silver at $85, one contract equals $425,000. 9% of that is $38,250. So your margin requirement just jumped from $32,500 to $38,250. That's a $550 increase per contract, a staggering 17.7% increase implemented overnight without warning. During a historic rally, you might think, okay, they increased margins by 18%. That's unfortunate, but not catastrophic, right? Wrong. Dead wrong. Here's why this is absolutely devastating for retail participants. If you were already leveraged to maximum capacity, if you had deployed every available dollar across multiple contracts, you received a margin call this morning. A margin call means your account no longer meets the new margin requirements. Your broker sends you a notification with two stark choices: deposit additional cash immediately to satisfy the new requirement, or close your position. Sell everything and exit. Most retail traders don't have an extra $50,000 or $100,000 in liquid capital ready to transfer at a moment's notice. So they're forced to sell. They must liquidate positions at whatever price the market offers right now. And when thousands of retail traders are simultaneously forced to sell, what happens to prices? They collapse, they crater. Not because fundamentals changed, not because silver supplies suddenly increased, not because industrial demand decreased, but because the exchange changed the rules to manufacture forced liquidation. This is textbook market manipulation. This is the CME and major banking institutions changing the rules mid-game to shake out retail investors who dared to bet against them. And this isn't their first rodeo. Let me give you the historical context, because this pattern repeats itself like clockwork. January 2011. Silver was in the midst of a powerful rally, surging from $18 per ounce to nearly $30 in just months. Retail investors were piling in. Momentum was building. The squeeze was intensifying. How did the CME respond? They raised margin requirements 5 times in 9 days. Read that again, 5 times in 9 days. They increased margin from $6,000 per contract to $21,000 per contract. That's a 350% increase in 9 days. What happened to the price? It crashed from $30 down to $26 within days. Thousands of retail traders were forcibly liquidated. The rally appeared finished. Everyone thought it was over, but it wasn't over, because the fundamentals hadn't changed. Silver recovered and continued climbing. By April 2011, it was approaching $50 per ounce. And what did the CME do? Same playbook, more margin increases. Then came April 24th, 2011, a Sunday night that lives in infamy within the silver community. They delivered the knockout blow with massive margin increases when markets were closed so nobody could react. When Monday's markets opened, the price gapped down catastrophically, crashing from $50 to $42 in a single session, then continuing to fall. $35, $33, eventually down to $26 by September's end. This event is known as Silver Sunday. It wasn't caused by market fundamentals. It was caused by rule changes designed to crush retail investors and protect banking interests. Now we're in 2026. History is repeating itself. Silver just broke $85. Shanghai is trading at $93. The squeeze is on. The system is fracturing. And what does the CME do? They raise margins. They switch from fixed dollar amounts to percentage-based calculations. They force liquidation. They manufacture a sell-off. Same playbook, same tactics, same objective. Protect the banks, crush the retail traders. But here's the critical point. It didn't work long-term in 2011. Yes, they crashed prices from 50 to 26. But silver didn't stay at 26. Over the following decade, fundamentals reasserted themselves. In 2020, 2021, silver launched another massive run. And now in 2026, we're entering the biggest silver bull market in history. No amount of margin manipulation can stop it, because this time is fundamentally different. This time, the shortage is undeniably real. Industrial demand is exploding. China has shut down exports. The Shanghai premium is $14 and widening. The physical market has completely disconnected from the paper market. And you cannot manipulate physical reality. You can manipulate paper contracts. You can change margin requirements. You can force people to sell futures positions. But you cannot force a solar panel factory to stop needing silver. You cannot force Tesla to halt electric vehicle production. You cannot force the Chinese military to stop manufacturing missiles. And you cannot print physical silver out of thin air like you print dollars. So the manipulation will ultimately fail. It will delay the inevitable. It will shake out weak hands. It will create volatility and fear, but it won't change the destination. The destination is $375 per ounce. Let me explain exactly why. While the CME was busy rewriting margin rules to protect banking interests, one of the world's most respected macro strategists released an analysis explaining exactly what's about to happen to the global economy. His name is Tom Bradshaw, a financial industry veteran with decades of experience. He's not some random internet personality. He's not a conspiracy theorist. He's a professional analyst working with institutional clients. Bradshaw just presented something he calls the 38% signal. Here's how it works. Bradshaw studied every major economic cycle over the past 50 years and discovered a pattern with 100% accuracy. Not 90%, not 95%, 100% accuracy. Here's the pattern. Whenever gold rises more than 38% in a single calendar year, a severe recession follows within 12 months, every single time. Zero exceptions. This has occurred 3 times in modern history, 1973, 1980, and 2008. In 1973, gold rose over 40%, from $63 per ounce to 97. The following year, 1974, the United States entered one of its worst recessions since the Great Depression. Unemployment spiked. GDP contracted. The stock market crashed. Inflation soared into double digits. It was catastrophic. In 1980, gold rose over 100%, from $512 to $850. The following year, 1981, brought another brutal recession. The Federal Reserve raised interest rates to 20% to break inflation's back. Unemployment hit nearly 11%. It was devastating. In 2008, gold rose over 30%, from $833 to $187. The recession accelerated into 2009, the financial crisis. Lehman Brothers collapsed. The stock market lost 50% of its value. It was the worst economic disaster since the 1930s. The pattern is crystal clear. Gold rising more than 38% in a year is a warning signal. It's the market screaming that something is fundamentally broken in the financial system. It's capital fleeing paper assets for hard assets because people no longer trust the system. And now in 2025, gold rose over 40% from around $3,000 to over $4,600. The signal has triggered. The alarm is ringing. According to Bradshaw, the recession is coming. But Bradshaw doesn't think we'll just slide into recession and stay there forever. He believes the pattern will follow the same playbook as 2008. First, there will be a short-term liquidity crunch where everything sells off together. Stocks, bonds, commodities, crypto, everything crashes because people need cash for margin calls, debt payments, and covering losses. In 2008, gold and silver actually sold off initially, not because they were bad investments, but because people were forced to sell everything to raise cash. Gold dropped from $1,000 to $730 in weeks. Silver plummeted from $21 to $8. But then, after the Federal Reserve intervened, after they printed trillions of dollars, after they bailed out banks and flooded the system with liquidity, gold and silver exploded. Gold went from $730 to $900 over the next 3 years. Silver rocketed from $8 to $49. The real bull market didn't start until after the crash. The crash was the shakeout, the final liquidation of weak hands before the big move. Bradshaw thinks we're about to see the same pattern. Short-term liquidity crunch, everything sells off, everyone panics. Then the Fed prints and gold and silver go vertical. And here's where it gets absolutely wild. Bradshaw has specific price targets for this cycle. $9,000 per ounce for gold and $375 per ounce for silver by 2028. Let me repeat that. $375 per ounce for silver. Not $100, not $150, $375. That's over 4 times the current price, a 440% return from 85s. He's not inventing these numbers. He's basing them on historical patterns, monetary expansion, debt levels, and industrial demand. He's analyzing the same data central banks are analyzing, and he's telling you the system is going to break, the dollar will lose significant value, and hard assets will explode in price. Now let me connect all these dots for you, because everything I've told you is interconnected. The CME just raised margin requirements. Why now? Why during a rally? Why when silver just broke $85 and Shanghai is trading at $93? Because they know what's coming. They know Bradshaw's right. They know the 38% signal has triggered. They know a recession is coming. They know that when the recession hits, when the Federal Reserve prints another $5 trillion or $10 trillion to bail out the system, gold and silver will go parabolic. And they know that if retail traders are still holding positions when that happens, the banks are finished. Because the banks are massively short silver, they've been selling paper silver for years to suppress prices and profit from manipulation. But if silver goes to 375s, those short positions become catastrophic losses that could bankrupt major financial institutions. So what do? They change the rules now, before the big move. They raise margins to force retail traders to sell. They create fear and panic. They manufacture a pullback. They shake out weak hands so that when the real rally begins, when silver goes from 85 to 150 to 250 to 375, retail investors aren't in the trade anymore. We got liquidated. We got scared out. We sold at the bottom. And the banks cover their shorts at reasonable prices before the explosion. This is financial warfare, and we are the target. But here's the beautiful thing. They're showing us their hand. By changing the rules, by raising margins during a rally, they're admitting they're scared. They're admitting they're losing control. They're admitting the fundamentals are against them, and their only option is to cheat. And when your opponent is that desperate, when they have to cheat to beat you, that's not the time to fold. That's the time to hold. That's the time to double down. That's the time to look them in the eye and say, I'm not selling. Now let me show you the disconnect between the paper market and the physical market, because this is where the lie becomes crystal clear. In the paper market, the CME just raised margin requirements. Leverage is down, forced selling is happening. Prices are under pressure, traders are panicking. But in the physical market, nothing has changed. Shanghai is still trading at $93, an $8 premium over COMEX spot price. US dealers are still charging $8 to $10 premiums for physical coins and bars. Some dealers charge $15 over spot. Mints still report 8-week delays for new orders. The physical shortage is still real. Vaults are still empty. Industrial demand is still exploding. The Chinese export licensing system that launched January 1st is still in place. None of the fundamentals have changed. The only thing that changed is the rules of the paper casino. Here's the key insight. The CME can change margins to 100% if they want. They can make futures trading so expensive that nobody can afford it. They can effectively shut down the paper market. But that doesn't create a single ounce of physical silver. It doesn't open a new mine in Mexico. It doesn't convince China to resume exports. It doesn't reduce demand from Tesla, Apple, or solar manufacturers. All it does is temporarily suppress the paper price, while the physical shortage continues worsening. Eventually, the paper price must catch up to physical reality because you cannot deliver paper. You cannot build a smartphone with a futures contract. You cannot make a Patriot missile with an ETF share. At some point, someone needs actual metal. And when industrial buyers stand for delivery when they demand physical bars and the COMEX cannot provide them, the paper market dies and the price goes to wherever the physical market says it should be, which, according to Shanghai Premium, is already $93, and according to Tom Bradshaw's analysis, is eventually $375. So here's what the CME is trying to do. They're trying to create a sell-off today, right now, to scare you. They want you to see the red candle. They want you to see silver drop from 85 to 82s or $80 or 78s. They want you to panic and think, the rally is over, the bubble popped. I better sell before it goes back to $50. They want you to forget Shanghai trading at $93. They want you to forget physical premiums. They want you to forget the industrial shortage. They want you to forget Tom Bradshaw's $370 target. They want you to focus on the $500 pullback and panic sell, so they can buy it cheap, cover their shorts at $80 instead of $150, and survive the coming squeeze. So let me be absolutely clear about what you should do right now